Well, good morning, everyone, and welcome to the Experian Quarterly Business Credit Review for Q2 2020. Starting with today's event, we're going to be using GoToWebinar, which is a slightly different from the previous quarterlies that you may be used to. On the left side, you will see the GoToWebinar viewer, and that's through which you're going to be seeing today's presentation. You should also see some of us on screen now on our cameras. To the right is the GoToWebinar control panel. That's where you can raise your hand, ask questions. You'll also find your audio selections there if you need to make any adjustments. And be sure to send your questions throughout today's talk. We've provided a copy of the slides. If you want to follow along, we've put them in the handout section. We'll also include a link to the slides in our follow-up email. During today's webinar, we're going to be discussing key findings in the Experian Moody's Analytics Main Street Report for Q2 2020, and the review will be presented in 3 segments. Presenting from Experian will be Brody Oldham. He's the Senior Director of Analytics Consultancy. Presenting from Moody's will be Christian Doridis, Assistant Chief Economist, and Associate Economist Derek Grunfelder-McCrank. And again, if you want to take that opportunity, be sure to use that question answer applet and get those questions flowing. We'll try and leave some time at the end to tackle some of your questions. And without further ado, I'm going to hand things over to Christian.
All right. Well, thank you very much, Gary, and welcome everyone to our quarterly Outlook session here. It's hard to believe it's been only 3 months here, and so much certainly has happened that we'll get into. Before I do get into the economic outlook to start us off, I thought I'd do a little bit of self-reflection, right? Obviously, I'm part of an economic forecasting firm. We produce a number of forecasts and really scenarios. I always make the point that we don't produce predictions as much as we produce scenarios. So a variety of different potential outcomes that help us to gauge what are the probabilities of certain events, much like the weatherman. So looking back at my notes over the last few years, I did want to see how we've done in terms of at least a baseline discussion. And I take some pride in the fact that over the last 2-3 years, we had been suggesting that the odds were higher for a recession in 2020. So for what it's worth, that's for better or worse, I guess, or for worse, that certainly came to fruition. Of course, where we absolutely missed the boat was in terms of the severity of this recession. We were certainly calling for more of a garden variety type of recession, just given some of the fundamental imbalances that had gone on, and certainly COVID was not on our minds. That said, I think as we look at the economic outlook and where we've been in the chart here, you can see certainly that we did certainly plunge into recession in the second quarter here, starting back in March, with the COVID-19 spread really taking off, and with so many lockdowns going into effect. You saw the economy pull back about 9% off of the peak, so a significant decline from that previous high, really unprecedented going back to World War II. By May, June, we did go through some reopenings, so you do see that bump up in what we estimate for Q3 in terms of economic activity, getting us about halfway back to where we were, so still well below the prior peak, but making some significant progress in a short period of time. From here, our baseline outlook would have us treading water, so to speak, so moving a bit sideways over the next few quarters as we await either a vaccine, an effective therapy, or other risk mitigation efforts around the virus itself. It's critical that consumers as well as businesses see some type of resolution to the virus. That's going to be the trigger for them to increase spending and investment. Once that happens, we do anticipate stronger growth during what we might consider a post-vaccine type of recovery period, as you can see here, which we estimate would be in the latter half of 2021 going into 2022. But really, we don't get back to February levels of output of GDP, as you can see here, until 2022. So that's an overview just to set the stage in terms of our baseline outlook here. Now, as we move on to the next slide here, the employment figures, which we also monitor very, very closely, tell much of a similar story. If you look at non-farm employment, relative to February or January, where we started the year, right, we did see that tremendous plunge in employment back in April. So very consistent with what we saw with output. We lost about 14% of our labor force, of our payrolls, back in April, a little more than 20 million jobs, right? So that's also unprecedented in terms of such a shock in such a short period of time. Since then, we have made some progress. We've put about half of those people back to work, but that still means we're in a deficit of about 10 million jobs relative to where we were back in February or March, right? So that there's still a lot of work to go, or a lot of recovery left to get us back up to even the levels that we had back in February. The other thing to note on the slide here, and very important as we think about a forecast, is although we made some big gains in employment back in May and June, those gains have started to slow. And I think that does support the view that this is going to be a longer, slower recovery from here on out, not so much a V as a long, extended type of check mark going forward. And that's true whether you look at output or employment or a number of other economic indicators. Focusing a little bit more on employment by sector as we start to drill down and think about small businesses in particular. In the chart here, I'm showing you the change in those employment figures by major industry. And the first thing you can note on this slide here is that every industry across the board here is still below its February levels, right? So we're still certainly in recovery mode across all industries. There's no industry, no broad industry, I should say, that has fully recovered or is even thriving after the initial shock, right? So still lots of work to do across every industry. Of course, some industries are being harder hit. Leisure hospitality being at the very top of the list in terms of hardest hit. We're still about 26% below the level of employment that we had back in February, and you can see that by looking at the last group of bars in the chart here. So as of August, as of our last read of the labor market, we're still about 4.2 million jobs short of what we had back in February. So many small businesses do participate in leisure hospitality industry, right? Connected through either hotels or many taxi services or other types of small businesses are deeply ingrained in that industry. So certainly there are substantial risks in terms of recovery there. And as we think about a longer term forecast, part of this industry is unlikely to recover at all. Some of that business travel that had been going on in the past is unlikely to recover as we get more comfortable with video conferencing, working from home, working remotely. A couple other things to note on the industry chart here before we move on would be healthcare, for example. It might come as a bit of a surprise to see that healthcare employment is still about 1.1 million jobs short of what we had in February. Right, given that this is a healthcare crisis, we might have thought that all the healthcare workers would be back to work and then some. But we still have a number of dentist office, smaller general practice type of offices that are closed or operating with reduced staff, or even hospitals, which had postponed a lot of elective surgeries to deal with COVID, are still coming back online. So that is an industry we do expect to get back up and running within the next year, but still, the recovery is going to take some time. Another key industry to focus on as we think about small business is actually government. And government here is made up, or government employment here is made up predominantly of state and local governments. These are sectors that have been particularly hard hit by the COVID crisis here, both on the revenue side in terms of tax revenues being down, given lack of income, lack of spending activity. And then on the cost side, you have a lot of additional costs as these state and local governments deal with the impacts of COVID-19 directly, right? So the need for first responders, police, other services is up. So this is an area, though, that is also highly dependent on, or provides a lot of opportunities for small businesses, right? State and local governments like to favor their local business providers. Without some additional support, there's a real risk that these government budgets will be slashed, and we will see not only additional job losses directly tied to government, but then spilling over to some of the small businesses that we'll talk about as well. So that is certainly one industry I would focus on as we're thinking about small business. On a more positive side, you can think about construction. The construction industry also has suffered in terms of job losses, but is quickly making amends. And you see construction activity picking up. And this is a positive actually for local businesses. Every new housing start creates a number of opportunities across different industries. So this could be a growth engine going forward for local economies overall, and then for small businesses in particular. So we'll want to spend a little bit of time talking about construction, certainly as we get into comments that Derek and Brody will make. As we think about the future and where things might be headed, we want to focus on small business confidence and confidence overall. So confidence measures are surveys of consumers and businesses that try to get a sense of how people are feeling when it comes to the current and future economy. And these confidence indices tend to be very highly correlated with future spending, right? If people are feeling confident, if they see a future, they're going to be a little bit more willing to open up their wallets when it comes to spending, or businesses certainly will see more opportunities when it comes to hiring and investment. As you look at the confidence measures today, you can see that across the board, both consumers and small businesses, confidence has plunged, as you might expect, given the COVID crisis itself and all the uncertainty around it. You saw that initial plunge back in March and April. In the summer months, you did see a little bit of a recovery as the economy did open up. But most recently, you've seen that confidence has retraced once again. There's been another leg down. So that uncertainty remains. Consumers are still on edge. They're not completely buying the fact that the economy may be on the mend, and they're waiting for another round, another wave, if you will, of both infections as well as potentially small business closures, so other business closures, and the associated job losses. Same thing on the business side, right? Confidence had increased earlier on, but in our most recent read, you see that confidence has deteriorated. The one exception, perhaps a glimmer of hope, is that small businesses tend to be a little bit more optimistic than businesses overall across these surveys. So that might be some indication that we might be closer to a stronger recovery than the general population might believe. Small businesses' optimism is remaining robust, although the caveat there is still it's well below what it was at the start of the pandemic. So something clearly we want to keep an eye on here. There are some signs of positive movement, but it might be 2 steps forward, 1 step back from here on out. Another piece of data that we can focus on to get a sense of where people are spending, where there might be some opportunities for faster growth in the short term, would be the retail sales data. And on the slide here, we're looking at the year-ago change in retail sales for July. The numbers for August just came out yesterday morning, so didn't make it in time for the presentation here. But by and large, the trends are quite similar from July in terms of which areas or which spending categories are growing fastest. And so what you do see is that consumers are focused still on online spending, given the health risks that still exist, given the spread of the virus. So any business with an online presence certainly stands a better chance for growth. You also see that consumers are focusing on their homes, so spending more at building and garden centers, right? Given that they're not going on vacation perhaps this year, and they're spending more time at home working, they are investing in making improvements to either their home office setups or maybe their decks or patios, given that they're really not going anywhere anytime soon. They're also spending more in grocery stores relative to restaurants, so preparing more food at home. Right, that is a trend that's been in place now for several months and continues to show growth. And then perhaps a little bit surprising from a broader recession context is motor vehicle spending actually is strong relative to where it was last year. Typically in recession, you see consumers pulling back on durable goods like a car or appliances or furniture. This time around, given the health risks here, you do see that folks are purchasing automobiles as they're preferring to drive rather than take public transportation. Last point to make here is you do see weakness still in restaurants, all right, given the lockdown measures. There's been some improvement over the last month, but still we're well below where we were last year. And that does relate certainly to a number of small businesses. Looking at the business landscape, a couple of points to make here are, first of all, that we do see the number of bankruptcies is growing and continuing to grow. You see a list here of some of the major bankruptcies that have occurred so far this year. Lots of retailers, which maybe were already experiencing weakness, and then COVID-19 pushed them over the edge, and so they're in bankruptcy. But it also includes some other larger corporations like the Hertz Rent-A-Car bankruptcy back in May. Right, so our expectation is that despite all the government support that may have been received, there still is certainly weakness. We do expect to see additional bankruptcies going forward, and that unfortunately is going to lead to some additional job losses over coming quarters. So one key takeaway here is that we should be prepared for another wave, if you will, in terms of job losses, in terms of economic weakness, as a number of businesses that may have tried to stay open with support face a new reality in terms of the demand for their goods and services. In terms of small business, a lot of small business, the bankruptcy data may be of limited value in assessing what's going on with small businesses. Oftentimes, small businesses don't actually file for bankruptcy. They may just close their doors and not open again. There's a cost to filing for bankruptcy. You can't use your PPP funds, for example, to file for bankruptcy. So that those measures of bankruptcy filings may not provide us with a complete picture of what's going on in the small business community. So instead, we've been using data such as that from Yelp, right? Yelp.com, as many of you know, is a listing service for restaurants, shopping, retail, a number of different outlets that customers might use. And what you see in the Yelp data is that since March, about 100,000 businesses have been marked as closed on the Yelp platform. So it does point to the weakness in the small business community overall. Lots of concentration in, or a high concentration, I should say, in restaurants, shopping, and retail, as well as some beauty and supply, or beauty and spa outlets. Restaurants, as you can see, are indicating not only that they are closed, but a majority of those closures are indicated as permanent. Right? Restaurants are going to be particularly challenged in this environment where even with a relaxation of lockdown restrictions, they can't operate at full capacity. Most restaurants operate on very thin margins, so if they're not able to reach a minimum number of customers, they just can't operate. So we should expect to see a number of closures here in restaurants as well as retail outlets as we continue to move forward through the recovery here. So I think, again, it supports this view that we'll have a long, slow recovery versus something that's going to happen very, very quickly. Okay, I did want to leave on a somewhat positive note here. There's certainly a lot of uncertainty and a lot of downside risk, but there are some more positive signs, some potential green shoots here. One of them is just the level of new business applications. Typically, an economic downturn might be associated with a decline in business applications, and certainly early on in this environment, you did see a decline in the number of new business filings, right? So if you go back to March or April, say weeks 11 or 12 of this year, looking at the blue line, you see that those new business applications were down. Now, some of that was just due to operational issues or challenges. Some of the government offices were closed or running on limited capacity as we were going through shutdowns. The good news is that more recently, over the last couple months, you've seen those business applications rising, and they're more than offsetting the losses that we had earlier in the year. So that certainly points to the optimism, the dynamicism of the American economy. You see people who maybe are laid off, but looking for new opportunities, looking to start their own businesses. So that is a positive sign for the future, and certainly one I'm following very, very closely. I hope this trend does continue. And if we do look back at previous recessions, you do see some real success stories of businesses that were started in recessions when capital might be cheaper or real estate values might be depressed or labor is more available. Some of the largest corporations, such as Microsoft, were started in the middle of recession. So if we want to think beyond the current weakness, there are some brighter spots on the horizon. And if you look across the country, you can see that a number of those business applications are occurring in eastern states, which is also a switch over the last couple of years. You see that in the Southeast in particular, you do see that the number of business applications has been rising, and also in the Rust Belt in some of those manufacturing centers, whether it's Pennsylvania, Michigan, Ohio, or Illinois, you do see that those business applications are up. So again, I think it points very positively to the strength and the robustness of the U.S. economy. People do pull themselves up by their bootstraps and look for opportunity, even when the chips are down. So I think as we get beyond the corona crisis, we come up with a resolution to the virus, we deal with some of these business failures that are occurring, as well as the lack of some of the fiscal support that's out there. We get past the election and all the uncertainty that's creating. I think the back half of 2021 does look certainly more optimistic, right? There is some pent-up demand out there from consumers, and businesses are starting to see some opportunities on the horizon. So I'll leave you with this more optimistic note. And then my last slide here, before I turn over to Derek, just providing you with our scenarios. So going back to my first point about Moody's Analytics producing forecasts and scenarios. For the unemployment rate, our expectation is that under our baseline scenario, moving sideways in terms of unemployment for a while over the next few quarters, and then once we get resolution to some of these outstanding issues, we could see some acceleration in 2021, 2022, moving us back to full employment as we restructure the economy. There are certainly some upside and downside risks. That's why I produced some of these alternative scenarios that you can see here. All right, things could turn out much worse in terms of another round of coronavirus infections or another round of business bankruptcies, but there are certainly some more optimistic scenarios as well, where maybe we get a therapeutic or a vaccine in short order, and that helps restore confidence more quickly. So I'm going to stop there. I look forward to all the questions that you might have in our Q&A section, but let me turn this over to Derek in the meantime. Derek?
All right, thank you, Chris. So I like to start every webinar by just saying a little bit about the data that we have. So Experian provides us at Moody's with small business credit data set. It contains almost 8 million small businesses at the moment, which gives us a really good view into what's happening in small business credit, because so much of the small business credit universe is covered in this data set. So we have a broad view of what's going on, and we can really get at what's happening for small businesses in the economy today. Jumping right into things. So small businesses have been, I don't want to say fortunate, because this is certainly not a good time for small businesses, but the forbearance and government loan programs that have come out to help small businesses during this crisis have been wonderful in terms of staving off delinquencies, bankruptcies, and helping to keep these numbers looking good for now. So typically what we've seen, and what you see here, is there's a small rise in delinquencies. So far it hasn't been substantial. It's still about 1.6, 1.7% in terms of 31 to 90 days past due delinquencies, which are the intermediate period before things really start to move into default and later bankruptcy. So those loan and forbearance programs put out by the government, banks, and lenders, they've really helped these numbers stay low. So in the past, what we've seen is that delinquencies and bankruptcies start to rise respectively 2 quarters after things get bad and 4 to 6 quarters after things get bad. So over the next couple of quarters, we do expect that there will be some weakness appearing in these numbers, but it all depends on what banks are going to do with their forbearance programs and what the government is going to do in terms of any additional stimulus. So the small business landscape is, at least from a credit perspective, somewhat precarious right now, because we don't know whether things are going to get markedly better if there is additional stimulus, or if banks and lenders don't see that coming, they might start to pull back on their forbearance options a little bit, and then we would see some more weakness appearing in this space. So I think I have a bit of a lag. I've just tried to shift slides into the next one, and I'm not seeing that it moved. Let's try again.
Currently on delinquencies begin to rise, but more coming.
Okay. I don't know, Gary, I'm trying to switch slides. Can you move to the next one?
Yeah, sure.
Okay. So Chris started talking about this, saying that we are seeing a revival of entrepreneurship. so far, that hasn't been borne out in the credit data. So the new businesses that are being formed likely aren't being formed using credit, or if they are, they're just so new that they haven't appeared in the data yet. So it takes a couple of quarters for a business to be considered sound enough that it's going to appear in our data set. So we should be seeing those new businesses with a bit of a lag if they are in fact using credit. So when we report on Q4 numbers, we can come back to this and say, hey, that revival in entrepreneurship that we started to see in the middle of 2020, were those businesses using credit or not? So what we've seen at the moment is that fewer businesses have entered the data set of small business credit. So we've actually had a slight pullback in the number of businesses that we observe. Nothing too much. It declined 1% from the first quarter. So just losing about 80,000 businesses. Not too many when you consider how many are in the data set, but there has been that pullback on credit. And initially, no one knew what was going to happen. Everyone went into survival mode, pulled back on credit, pulled back expansion plans. This is nothing that isn't expected. As you can see, there was a dip previously in the number of businesses observed, and that was during the beginning of the commodity price upheaval that occurred in the 2014-2015 period. And you see it started to enter the data set in 2016-17, which is where that 4 to 6 quarter lag comes in as far as businesses leaving the data set and declaring bankruptcy. And that happened in the energy space before. This time we expect it to be broad-based and not focused on one specific industry. So the weakness is broader this time, but we know it's coming, and there are a lot of programs in place to help stave off business failure and closure. It won't be perfect, but hopefully it won't be as bad as some people were predicting early on during the COVID crisis. So Gary, I'm trying to switch slides again, and I don't think it's working. Can you? Thank you. So right now, great. Right now, from the NFIB surveys, which Chris had discussed earlier for small business confidence, the big problem that has really been hitting small business confidence is poor sales. You see there's in the first quarter and into the second quarter, there was a large spike in the number of businesses reporting that poor sales were their primary or most important problem. So as sales deteriorated, businesses didn't know if they could continue, hit confidence, businesses started to close as a result. You don't know if you're going to be able to pay your employees, pay your bills. So this is really the factor that is behind the closures we've seen thus far. Poor sales, just a lack of people coming through the door has really impacted a lot of the service industries, in particular in the data set, or service businesses in the data set. Gary, can you move to the next slide? This hasn't stopped commercial lending growth, although a lot of what we see here is the result of the PPP programs. So the government stepping in, saying, we don't want mass unemployment, even more than we had in the first couple quarters of the year. So the PPP loans really boosted commercial and industrial lending. Whether we see that continue is another question. Like I said earlier, you don't know if more stimulus is coming. We're currently operating on an executive order for redirecting emergency disaster funds to small businesses. So whether or not that's able to continue, we don't know. Whether businesses will regain confidence quickly enough to resume organic lending and borrowing on their own, we don't know. But so far, the PPP programs and government rescue has been good for small business lending in terms of boosting balances. that appear here, as well as the forbearance programs so that businesses aren't seen as overly risky or behind on their existing debt, so they can still take out new loans if they need the capacity to continue operating. And Gary, can you move to my final slide? So geographically, we've seen that the pain from COVID has been fairly broad-based across the country. No area has been immune from it, as herd immunity hasn't taken hold yet. Business immunity hasn't taken hold yet. So we are seeing continued weakness, as I said, particularly affecting service industries. So Chris had talked about construction earlier. One of the industries that was able to continue operating fairly early on was construction, even with business closure orders. Construction was deemed a vital industry, so those businesses were able to continue operating, and we should see them coming back fairly quickly. And their credit hasn't been as impacted as, say, service industries, as I said earlier. The service businesses are really spreading the weakness because service is so universal. Even if it's, you know, a local diner, without people coming through the door, that local diner is a service business. Their sales have suffered, their confidence is suffering. They might be temporarily closed, they might be permanently closed. For small business credit, the uncertainty is really the story of the day. And until we get into the next couple of quarters and can see where this uncertainty is leading us in the data, we're all kind of left sitting on our hands for the moment, waiting to see what's going to happen. So that's my portion of the presentation today, and I will hand things off to Brody.
Thanks very much, Derek. Okay, Brody.
Thanks, Derek. Yeah, sure will. You know, I'm excited to have an opportunity to speak with all of you today and to be here with Derek and Chris, being able to present some of our forward-looking views on the market, where we see it impacting small businesses, and then looking at how it's going to impact lenders as far as their choices on what types of cash they'll offer to the market, what kind of support and lending opportunities will be available to our small businesses. I always like to reach out and thank my buddy Rick here at Experian for helping me pull together some of the numbers today as we go forward. So looking forward to sharing some trends with you today on small business credit, looking across a couple products, and talking about how the macroeconomic view of our economy, which Christian talked about, and Derek this morning, how they're going to impact small business credit. So we're certainly looking at some slowing coming up here in the U.S. and North America. We'll continue to see that. We know from Christian and just looking into the market that we're probably going to see another round of unemployment claims coming up. Certainly going to hit us. Now, we may see Amazon hiring up 100,000 new folks to expand their business here in the U.S., but we're going to see others like Delta, American Airlines, other businesses that surround the travel industry start to have some trouble, and we'll see some additional unemployment claims coming out of those industries. Certainly even peripheral businesses that service those business travelers, we're gonna see some unemployment claims come from those industries as well. Now, my wife always wants me to get packed and get out, but I think our world has changed a little bit. So my distance and traveling may just be here to my office that you're seeing. Welcome to my house. And I'll talk to you a little bit from here about what's coming up. So we're going to start just talking about consumer credit and where it sits at this point. And I look at consumer credit from a business owner perspective. When we look across the industry now, where are small business owners going to get capital? If they can't get cash out of commercial products, or they're having difficulty, keeping their business up, where are they going to go for funds? A lot of times they go back to their personal credit. Now, we don't recommend that. It certainly doesn't help your consumer score to raise your utilization on your personal credit. But we do see that trend occur, especially for small and micro business owners, as they want to inject some capital into their business if they're struggling. Certainly as PPP is running its course, this is an opportunity for them to do that. Now, you can see here in the chart, I have a couple different visuals to review. You're going to see bank card up at the top, and this is looking across at the types of origination from prime to subprime, all the way through. And what you really notice here is that subprime lending is declining. We're seeing that credit scores are going up a bit for the average credit score of personal bank cards being originated. First mortgage, you're going to see that same trend. That subprime market is shrinking a bit. Super prime and prime, again, maintaining their levels, not jumping through the roof, but maintaining their levels. On the right-hand side of the slide, you'll see that first mortgage, that blue line is in the upward trajectory. We've seen housing prices stay pretty high. That equity is there for those small business owners to draw from. That has to come from those super prime and prime customers where those levels are that they're able to acquire those types of products from our lending community. And that criteria around those types of products has gotten tighter and tighter, especially around HELOC and HELoan. But you'll see this trend continue up, especially since we saw Jerome Powell, set the mark here. We're going to be a couple years here at near zero rates, and that means that your mortgage rate for a 30-year fixed is going to be between 2 and 3%. That's fantastic for those that are out refinancing, those that are looking for properties at this point. Certainly keeps those home prices up there and is securing those equity levels for small business owners that are out trying to look for additional cash. Now, we're going to see, again, unsecured market tightening. That bank card originations had dropped off. Everybody's prepped for a pre-recession turn in March, and they flipped the switch like we talked about. And when they flipped that switch, that means credit criteria on the consumer side got tighter. It means originations went down a bit. We're expecting that to level out a little bit more as we go forward. Not so much of a drop into the next quarter. Should level out a bit as we see some continued support, hopefully another stimulus package come in, and that should bring us back up. One of the things that as we move forward out of looking at the state of credit for our business guarantors, still looking pretty positive. Remember, as Derek discussed, there's some forbearance that's happening there. That's about to run out toward the end of the year for a lot of our business owners. That means that debt is still there. They're going to pick back up those payments. So it's going to put a little bit more stress on our business owners as we go forward as far as their consumer credit availability. Now, when we transition here from a small business owner into the small business themselves and look at commercial credit, we switch into our SBCS, our Small Business Credit Share database, the one that we look at, very granular in terms of cards, loans, leases. It really helps us to create signals to evaluate where we're going to see some of our challenges within these credit markets. So we're going to take the next 20 minutes or so to do that. I hope you're ready. I have my cup of coffee ready, so if you're not, stand up, turn around a couple times, get excited for the next set. All right, well, that's good stuff. All right, we'll switch down into our commercial credit, and I'm going to start with our unsecured commercial credit, or secured, looking at installment type originations. And what you'll see is that the general trend as we go across from left to right, when we got around March and April and into May, you're going to see that big spike in installment lending and from our Paycheck Protection Program, those PPP loans. You can see how out of the norm that really was for that amount of origination. And those originations happened with our fintech lenders as well as our FI space and our traditional lenders. So a good mix there of different providers offering those loan types. But you did see a big spike. Now that has subsequently come down as those loans, as the need for those loans backed off, we saw those originations certainly drop off. Delinquencies right around our normal level for the year, but we're going to look at some areas in the next few slides where we're seeing those delinquency levels peak up just a bit. All right, well, I do want to talk for just a minute about the Paycheck Protection Program. We mentioned it a little bit earlier. What you'll see is that the SBA released some information on the Paycheck Protection Program and who received it. Looking at those loans above 150,000, you can see most of the other loans that were out there are below that amount. And so we look at our across, it is reported within our SBFE data, our Small Business Financial Exchange. We're getting that those PPP loans identified within that data source, and so we can take a deeper look across the spectrum of what's out there. Now, when we just look at the types of or the performance of those that received a PPP loan versus those that didn't from a business perspective, what you can see along the bars at the bottom of our 30-day delinquencies, at the top, the two lines are 90-plus days delinquent. What you'll see is that those that received a PPP loan actually performed a little better as far as delinquency rates than our non-PPP participants. That's a good measure there, shows some good performance. What I do want you to notice is at the right-hand side of the chart, when we look at 30 days past due, what you'll see is that as we're getting to the end, as about 84% of our PPP borrowers have used their entire loan amount, we're seeing 30-day delinquencies begin to rise at the end of June, and we continue to see that into July and August. That means that cash flow that was there supporting when folks aren't coming through the door has gone away. That means that delinquencies will begin to rise. I'd like to mention here too that we are seeing an uptick in fraud. We even saw a piece of that within the PPP program. So again, fraud is a big focus during any downturn, and certainly during this one, something that you should be focused on, as well as, you know, even touching the PPP loans that are out there. I think they were identified about 57 people, businesses for about $175 million in loans where they're suspect of a fraudulent activity. Well, I want to, as we go away from PPP, it's something that you can look at as part of your evaluation as you go forward, looking at those businesses that have it or have not, and you'll see that performance follows it. When we look at installment lending, I just want to show you this chart quickly because I think it really highlights where we're seeing credit criteria go as far as underwriting when we look at origination risk. Now, what you'll see is the yellow and green bars, part of the stacked bar across the bottom. These are our low risk originations by volume. When you look across the top, you're going to see the red and the purple. Those are our higher risk loans. When we get over to the far right, you'll see March, April, May, June, leading into the end, and you'll see those green and yellow bars growing. Well, when those grow, that means that credit criteria is getting a little tighter. It means that lenders are lending into the less risky paper. And so as you evaluate this and take stock in what you're doing with your business, know that the industry is really trending a little bit tighter as far as their installment lending, and they've been doing so certainly since the beginning of the year. Ooh. Now, I'd like to show across industries. What you're going to see across the industries, again, is transportation and mining, which Derek mentioned a little bit on as well. Having a few more struggles here, you'll see that the criteria is tightening up a bit. Others are loosening, but a good thing for you to take a look at your leisure when you want to dig in a little bit more for the industries that you service. But it is a bit different when we segment it down at the industry level. Now, when you look at this also, we look at energy, you know, you've got to think not just locally here, but globally. We look at the energy sector and we think about oil. I mean, Derek talked about not focusing so much in, and I agree. I know that there are a lot of different factors, but one of these that you can point out is that we're going to see some natural gas expansion into Europe. We'll see those energy needs pick up as reopening continues. So we may see this lighten up a little bit as far as balance risk when we look across these portfolios. Certainly a way to do that is using a non-traditional tool like a risk index to look at a combination of some of these factors together, looking at the spread of the virus as well as some credit and macroeconomic information. That can create some differentiation when you're looking at two businesses, and it can tell you, especially if you go down into these segments, opportunity areas that you'll have as you go forward, either to originate or to monitor your portfolio. And monitoring is important when we look at this next slide. This takes us into 90 days past due. And if you look to the left, it's going to look regionally across where we're seeing some activity as far as delinquency rates. What you'll see is that the Northeast, even though they've calmed down in their virus spread, they've begun to open up. What we're seeing is delinquencies are beginning to trend up, certainly in the Northeast for our installment product. I will give you a little foretaste of what's coming up too. It's probably, you're going to see the same thing in unsecured as well. But what you see here is regionally, generally headed down as far as delinquencies, which is good. That PPP has continued to lift this up and kept those delinquencies down, allowed a portion of those PPP loans to be used for debt repayment. And so that's certainly helped. As we move forward, we're going to see more of those delinquencies trend up in installment and then in the unsecured products as well. One of the good things, if you look to the right of this, on the right-hand side of the slide, you'll see these two arrows that point, and it's looking in between our two bars here, looking at the difference between 60 and 90 days delinquent. When we see those far apart, that's not good. That means that you're have more of those going from a 60 days rolling into a 90, rolling into something more severe as far as delinquency. What we've seen in the past few months is that stayed pretty tight. That's what we want it to do. Now we want those to have some curability as we're looking at delinquency rates, maybe some slow paying, but not as much going into those higher delinquency buckets. So good to see, but we'll look to see if we, in the next few months, if that spread opens up a little bit more. That'll be something that we really want to watch and make sure that we're monitoring month to month as the spreads continue. That'll mean we'll see more of these delinquencies at a higher velocity. All right. Well, I want to take us into some unsecured territory here when we look at unsecured commercial credit cards. Again, we saw that flip of the switch in early March into April. We saw those originations slow. We see delinquencies going up for unsecured debt. Generally, when folks get in trouble, the unsecured will be the first thing to go, and they'll maintain some of their installment loans that are tied to the collateral that's available. So they'll work on their unsecured first. If we don't see stimulus, we project that we'll continue to see these delinquencies on the rise, and we'll see some leveling out again of originations as we go forward, as that evaluation of credit criteria right up front is going to we'll be taking a deeper look with our lenders. And I'll show you some of that here in this next slide. And this is certainly one of those where we saw, you'll see the uptick in our March numbers where it really got tight. You saw those recessionary switches being flipped. But after that, it loosened up a bit. I think in some lenders, they flipped the switch. They thought, this is a little too tight for a recession. Maybe we ought to open it back up, see if we can pull in, originate a few more, keep that balance sheet growing a little bit. And so they loosened up risk. As we're getting into June and July and August, we should see some continued tightening as this uncertainty over the next wave is growing. And we see that consumer confidence and that commercial confidence having a little weight to it. Now, this is one of the things that I'd like to just point out as we're working with some of our lenders and partners, and we look in the industry, some of the non-traditional data that's out there, that Derek talked to a bit, is looking at digital footprint, the availability to be open even if your site is closed. So how's your website? Do you have pickup? Are you expected to reopen? And certainly within the Yelp data that we saw, Christian, present to us, we see a lot more of those closures happening. So really looking at an opportunity to evaluate what's open and closed will differentiate how you're going to take some type of pre-treatment or treatment strategy with these businesses that are out there, or even markets that you're willing to expand into. So something important to think about as you're looking at how you might adjust your underwriting policies upfront or even portfolio management. Again, across unsecured, you're going to see different industries performing at different levels as far as the tightening or loosening of their credit criteria. That will have an impact on how well those industries have an opportunity to pull in some additional cash outside of PPP or the next installment. Hopefully we'll see that coming in soon. When we look at delinquency levels, you know, I touched on this a little bit earlier and I said, watch for this one. You see that those delinquencies across all regions on the left-hand side are really in an upward trend when we get into June. Northeast leading those certainly at a greater pace. When we look over to the right-hand side, remember what we talked about here when I said look for that expansion between the 2 points between our 60 and 90-day delinquency rates. We're seeing that expand. Now, as that expands, that means more of your delinquencies that get from that 30-day to the 60-day, more of those are going to roll into more of a higher delinquency level, and you need to start thinking about pre-treatment strategies when you get into the next couple months, and we're going to continue to see those on the rise. Now, when we look at, you know, we touched on this a little bit, charge-offs, again, credit card charge-offs are up. We're going to see some installment charge-offs down a bit because we still have PPP out there, lifting it up just a little bit more. But our expectation is that we'll see those as soon as unsecured kind of level off a bit. We'll see those installment loans begin to pick up a little bit more as far as as lenders charging those off. Line of credit still being pretty stable, but it's up again year over year. Now, commercial bankruptcies up about 28% through this year up to this point. In August, we're seeing Chapter 11 up. Chapter 7's down a little bit this year. The expectation, though, is that we'll see more and more of these bankruptcies as closures continue. We'll see more of these grow. We're going to be at the 2012 level, I think, by the end of the year when we look at potential bankruptcies for this year. So just be cautious of that as you're looking out, making sure that the businesses that you're evaluating or monitoring through a trigger program or a monitoring service, that you're looking at these potentials for businesses to have some instability. That's going to be really important in the next 2 to 3 months for sure. So just to wrap us up again, you know, thinking about some of the points that Christian brought up and that Derek talked to us about as far as small business trends, we're going to see macroeconomic view slowing in recovery, that check mark that Chris talked about a bit. You know, we were hoping for the V and we got the check mark. So hopefully we won't see a big virus expansion here in the next few months. If we can keep it maintained and pretty flat, I think it's really going to help us to speed up that recovery, but still through to 22 as we look forward. Commercial lending is going to continue to be slow, but we're looking for opportunities to adjust segmentation and offer non-traditional data out there in the market. I know a lot of you are evaluating that type of data to use in conjunction with your core data when you're doing some decisioning on new business. But we'll continue to see that be slow and level out. Hopefully we'll see a pickup here in the middle part of 2021. Now, delinquencies continue to be on the rise. Let's watch out as unsecured is going to really be our first driver of delinquency trends. We're going to see those really pick up. You're going to see that in both consumer and commercial as we get to the end of PPP and some of the stimulus and forbearance programs that are out there through the CARES Act. We're going to see moratoriums on collections lift, certainly in the energy sector coming up in October. Some states will be later through April of next year, but we'll start to see that debt open up for small businesses. That means they'll have to make payments, and you'll see some continued unsecured debt delinquency rise in that aspect. That means that with this increased velocity, collections are going to be up, and you need to really look at your treatment strategies at this point. So as we look at the market, slow, credit criteria tightening, unemployment leveling out. We really need to be cautious of what are the next steps up. Looking forward to how you can prepare for some of the changes that we'll see in the next few months and even years as we go forward and continue down that checkmark path. So I'm going to turn it back over to Mr. Stockton, see if we have any questions that we can address. And,
yes, we did have a few questions come in, and we've got Christian and Derek here. So the first one came in for your session, Christian, around the K-shaped recovery. The question comes from Brooks. And he asks, I've heard of a K-shaped recovery in the context of expanding income inequality. Do you expect a K-shaped recovery based on company size and access to equity markets?
Yeah, great question. Thanks, Brooks. Good to hear from you. Absolutely, I would expect to see, typically recessions do discriminate, right? They don't affect individuals equivalently. They certainly won't affect businesses equivalently either. So larger companies certainly have access to more resources. Great example of that, or a prime example of that, might be the commercial real estate market. I know we're focused more on the C&I sort of side of things, but commercial real estate certainly, if we think about the impact of the eviction moratorium, a larger firm is going to have additional resources. They'll be able to dip into the capital markets to make it through and cope with an eviction moratorium. A smaller mom and pop is just going to be is going to struggle much more in that environment. So yes, I do expect to see that the impact on businesses is going to vary certainly by size as well as by the industry that they're in.
Very good. Carly had asked about unemployment rate. She asked, could you go into detail about the unemployment rate percentage? What are the alternative scenarios or alt scenarios?
Sure. So these are Moody's Analytics produced scenarios. We run a large-scale macroeconomic model, feeding that with all the information we know about the economy each month. And then from there, we are able to create a distribution of potential outcomes based on some critical assumptions, right? In this particular environment, one critical assumption might be the spread of COVID-19. Another critical assumption might be the addition of fiscal stimulus. If we extend PPP or support to households, that certainly may affect the economic outlook. So those scenarios you saw on the chart there represent different percentiles in this distribution of economic outcomes. More than happy to follow up with additional detail about how we go about producing those if you'd like. So do feel free to reach out to me or contact me at help@economy.com.
Excellent, thank you. David asks, and about his questions about bankruptcy. Isn't it true that most small business closures will not involve a bankruptcy and the owners will just walk away because there are few assets and attorneys and accountants make the bankruptcy expensive propositions? So we're going to see some phantom business closures with no bankruptcy?
Yeah, absolutely. I'll jump in here, and then Brody, certainly feel free to add. But absolutely, I think that's why I actually track that Yelp data, because the smallest business is absolutely right, not worth it to go ahead and restructure or pay the attorney's fees. And especially in this environment, you might have received the PPP money, but there are restrictions on using that money specifically for filing for bankruptcy. So I do expect to see that we will have many more business closures than what the official bankruptcy statistics might indicate. So really,
I definitely agree.
Or the mark you want to look at.
I definitely agree, Christian, because you're really going to see those bankruptcies too. The mom and pops are gonna just close down. We see it here. I mean, if you walk around, you'll see businesses boarded up that were doing pretty well up until the point they said, there just isn't cash flow there for us to move forward. And so they're going to close down. That's why a lot of this non-traditional data, like we're talking about, Yelp is an example of that, but there's many others out there that can be brought into your process of evaluation to say, is this one that's really open or is it closed? Is the digital footprint there? Do we see foot traffic going into those locations? The state level rules preclude it from really opening its doors. It may have a digital footprint, but are they really getting cash flow from multiple channels? And that's really going to tell you that use of some non-traditional data is going to differentiate between who's going to be really successful coming out of this and who's going to say, like Christian said, are they just going to say, you know, there just isn't the market here for me to continue with what we've got. My margin is thin already. Now it's super thin. It's not worth me even coming to work in the morning, so I'm going to shut it down. And that may be why we're seeing in the Southeast a lot of that expansion in business applications is that some of those have already closed. And so we're seeing that reopening or looking for an opportunity to get into a different type of business than they were in before.
We've got a super detailed question here from Adam, and his is around different industries and VCs. He asks, thanks for this great session. Thank you. Do you think that PE and VC partners that have previously invested in strong e-commerce businesses such as ticketing or travel marketplaces will continue to fund these significantly impacted verticals, or could they let some of these investments go bust in the search of more lucrative investment opportunities? Super detailed.
Yeah.
Christian, I can see you're waiting on this one.
Yeah,
It really is
just
a
wanted to
good
give
question.
Eric a chance.
Oh, okay. Well, I don't have a whole lot of. Sorry, what was that, Gary?
I was going to say, if you want, we can circle back on that question. It is super detailed. And
Well, I'll say
have...
one thing. I think that we have that investment model. Certainly, investors are going to be looking at the performance. They're going to be looking at the segmentation and industries and their potential impact from additional spread, from macroeconomic pressures that are going to come not only from inside North America, but expanding outside into Europe and into some of our Asia Pac partnerships that we have around the globe. So some of those pressures we're going to see. I think investors are looking for opportunities to maybe redirect some of their funds. But at this point, it's one of those where we're waiting to see if we're going to get a little bit of lift. They're not totally running away from certain markets, but they're certainly more cautious than they were pre-COVID.
Right. Well, thanks so much for us.
I'll add one thing to that. So just anecdotally from the people I know in the VCP world, what Brody said is pretty accurate. They're going to look at the ROI, they're going to look at their metrics. And from what I've been hearing, if a business was growing and meeting the metrics that whatever VC or PE person was looking at before COVID, a lot of them are going to give them the minimal funding to get them through COVID because they think that on the tail end or after COVID is done, that business can resume growth. In the meantime, they may readjust the industries they're looking at as far as the big funding, but I haven't heard of many people just walking away entirely from any companies they had supported previously.
Very good. Thanks so much, Derek. Okay, folks, if you would like further information on Moody's Analytics, they've got terabytes and terabytes of information. You can find more information on their website, Moody's Analytics. So they do such a great job supporting these webinars. We hope you really enjoy the new format with a little more video. For more information on Experian, you can always find us at experian.com/B2B. And we'll pick it up next time for the quarterly business credit review for Q3. Should be very exciting. And thanks everyone for joining us today. Everyone have a good day now.